Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. Our guest today has financed over $500 million in multifamily properties and is invested as a limited partner in 21 multifamily deals totaling over 6,000 units. James Eng is Senior Director with Old Capital. James, welcome to Purchase to Profits. It's great to have you on the show.
Thanks for having me, Seth.
Yeah, really looking forward to speaking with you. So to kick things off, tell us about your real estate goals right now.
Yeah, so my goals really are to continue to build sort of my passive income through limited partnerships. And so about 4 years ago, 2015, I really started looking at multifamily, and I sort of set a goal for myself to essentially invest in a deal every quarter.
Nice.
And so, we're sitting here in 2019, 4 years later, and I've done about 21 deals. And so I'm pretty much on track. So pretty happy with the progress so far.
Yeah. And do you have a target that you want to hit with that income coming in from your investments? How do you frame it in your mind?
Yeah, I think the easiest is sort of a dollar per month goal. And so, right now, each property, depending if it's sort of a stabilized deal or value add deal, is probably about $1 or $2 per month coming in. And so I want to probably get to about 10,000 units. And as people, sell deals, and I'm sort of reinvesting that capital.
Yeah. And how are you finding your portfolio now? Are you finding that more people are selling, so you have more capital to reinvest?
I think usually after 2 to 3 years, people really, especially the market, most of my deals are in Texas. And so the market in Texas has been doing very well. And so they're hitting sort of their 5-year goals after 2 to 3 years. And so they are selling their properties. And so a lot of times it might not necessarily be a double of your initial investment. It might be, an 80% return, but they're doing it in 2 years versus 5. And so I'm taking that money and redeploying it back into deals that makes a lot of sense.
Yeah. And you say, thank you very much.
Yeah,
And then off we go to
exactly.
the next one. So for yourself, do you have any routines or rituals that you follow maybe daily or weekly that helps keep you focused?
Yeah, I think, for a limited partner, their job is really to meet general partners. And so I am constantly either attending conferences or even on a weekly basis, looking at deals that come on the market. So even as a limited partner, I want to see deals that are coming on the market, understanding, what's for sale. And typically, let's say a deal goes on for sale today. It's listed by a listing broker. In 2 months, it might be under contract, and then I'll see that package come through from a general partner. And so I like to really understand what's on the market and just constantly. So probably like every Monday, essentially, I go through. There's like 10 listing brokers that control a majority of the deals here in Dallas-Fort Worth, and I'll go through all of their websites and distribution emails and look through the deals that they are currently selling and understand what they're trying to get for those deals. So I understand the market, the sub-market, and then also the price that they're trying to get to.
Yeah. And from your perspective as a limited partner, you're doing a lot of work to understand the market. And I think that's something other limited partners could do a little bit more, because some people don't really do that homework before they invest in a deal.
Yeah, I think it's important to, number one, choose the market that you want to invest in, but then also figure out what general partners have experience in that market. And, the guys that I invest with, they typically have a track record in the specific market that they're investing in. And so they can point to, 3 or 4 properties that are in that area that they've, successfully have rehabbed, raised rents, and then either sold the property or refinanced the property.
Yeah, for sure. And for you, with your business, you're involved on the financing side. What sort of things would you tell to or say to, let's say, an operator who brings you a deal? What sort of things are you looking for?
Yeah, so I mean, I think the first question is typically let's figure out what type of debt the property is going to qualify for. So whether that's a Fannie Mae or Freddie Mac deal on a stabilized property, that's going to be a little bit safer deal, not as much upside. Maybe you're buying it for cash flow. So I want to understand that. What's the amount of risk in the deal in terms of rehab, and then in terms of execution risk? Because if you come to me and tell me this is your first deal and I'm doing a heavy value add in a tough area, I'm going to probably give you a little feedback that that's probably not your first deal. And you should
Yeah.
probably be doing something a little bit more stabilized and maybe, raise rents, 5 to 10% with some interior rehabs. That's typically the first time person's property to buy. And then, but if you have 3 or 4 deals under your belt and you want to buy a heavier value add deal and we need to do a bridge loan, then I want to see, all right, what's your pro forma years 1 through 3? How much rehab is it going to need? And then how are you going to get to those rents? Because I want to see your exit analysis on that bridge loan. And can you achieve, let's say, the rents that you want to get to and actually refinance this bridge loan and get out of the deal versus, a first timer, they're going to do a Fannie or Freddie loan and then it's going to be pretty much stabilized out of the gate.
Yeah. And are you seeing a trend now where maybe some operators are being a little too aggressive with their underwriting, just where we're at in terms of the market cycle?
Yeah, I mean, it's hard to say because when I started in 2015, so I left, so I was at G Capital for 10 years, underwriting commercial loans across the U.S. in every different property type. And then when I came over to Old Capital in 2015, essentially everyone thought multifamily was super hot and too expensive. And now 4 years later, all those people have sold their deals and doubled their money and their investors' money. And
Yeah.
so it's hard to tell. I mean, you definitely need to be a little bit more conservative. I would say on the underwriting, the couple things that I see people be a little bit aggressive on are definitely residual cap rates. That's probably number one in terms of, okay, you're buying at a 5.5 or 6 cap. Like, what are you going to exit at is probably number one. And then number two is just sort of like your constant rent growth and the cutting of expenses. And so the way I like to see that, I mean, most deals, you're probably at a 2 to 3% annual rent growth. And then I like to see, on a B to C, Class B, Class C deal, I want to see like a 50% expense ratio, 55% expense ratio. A lot of people grow rents significantly faster in their pro forma. And then by year 5, it's at a 40% expense ratio. And that just, I mean, it's not going to be underwritten that way when you go to sell that property.
Yeah, no, well, 100%. So out of all the deals that you've done so far, is there one that stands out as a Keystone deal?
Yeah, I mean, I think it's the first deal that I invested in as a limited partner. It has the most history. So I invested in that deal back in 2015. And so it's probably only like 10, 15 minutes away from my personal residence. And I had known the operator. He actually worked at GE with me previously. And so he had been doing it for a couple of years. He had like 3 or 4 deals under his belt. It was close to me in terms of location. And then essentially I got comfortable with the deal by driving it, number one, but then also sort of believing the story of the general partner. And so, I mean, in 2015, we invested in the deal. I think for any limited partner, writing the first check is the hardest check. And, you don't know when the money's going to come back. You have a forecast, you walk the property a couple times and that's about it. So that first deal is definitely the hardest. So getting over that hurdle is definitely, once you get over that hurdle, each deal after that is easier and easier. And so on this particular deal, just to give you a little background, essentially it was a Class A minus deal in Plano, which is a suburb of Dallas. And essentially we went in, raised rents, did some sort of light capital. And in 2017, we were able to refinance about half the equity with a supplemental loan on a Fannie Mae, which basically, allows you to return some of your equity back to your investors. And then in 2018, someone brought us an offer sort of off market, and we were able to sell the deal for essentially about a 90% total return in, I guess it's 3 years. And
Nice.
so it wasn't a double of the equity, but essentially, on the 5-year horizon or 5-year forecast, they wanted to double the equity, and they essentially got 90% done in 3 years. And so for a relatively safe deal that it cash flowed to probably about 6.5% on a quarterly basis or on an annual basis. And, never, I think it's sometimes good to do one deal, even though it's a little bit more conservative. There's definitely deals in 2015 that outperformed that deal. But I think it helped just to get that deal done. I mean, the occupancy, the whole time we owned the deal was never less than 90%. And so there was not just like a heavy value add or anything like that we were doing to it, but just sort of your slow and steady, investment that, after doing that one, essentially I think in 2015, I probably did 3 or 4 more. And so it gave me confidence that, the money actually went into the property, the deal closed, and you got your money back out. So it was more just of a proof of concept for me. And then it also helped the story with my wife. So that always helps.
Yeah. And what attracted you to investing in multifamily as a first deal as opposed to, let's say, a shopping center syndication?
Yeah, I mean, so when I was at GE Capital, I was an underwriter there, and from 2008 to 2000, let's say 10, we didn't originate any new deals, and every one of us became essentially like a portfolio manager or a loan asset manager. So we saw these deals go through the downturn, and we foreclosed on almost every other property type. So we foreclosed on retail, office, industrial. The 2 property types that we did not foreclose on were multifamily and self-storage. Those were the 2 that we essentially just gave them an extension of the loan, and they were fine. They were paying their debt service. They had maturities come up, but we just gave them another 3 to 5 years, and then they came out the backside and they were all fine. Yeah. And so when I was looking, all right, if I'm putting my personal money into these deals, what am I going to choose? And multifamily worked for a couple reasons. Number one, I understood it. And then also number 2, there was syndication opportunities in that market. And, I think there's like 800,000 units in Dallas-Fort Worth. And so there's a ton of owners, a ton of different equity structures. And so you could find people to invest with. You didn't have to have all the money yourself. And you could, meet general partners, whether it's at conferences or investment groups, and then invest with them and, sort of put a little money at risk. I mean, I definitely think that is the only way you can really learn is if you put some money down on one of these deals, and you watch those monthly reports a lot closer when you have 50 or 100,000 in a deal.
Yeah, no, I absolutely. And so what sort of things do you as a limited partner look for in an operator when somebody approaches you with the deal?
Definitely first thing is sort of background of the operator and what they've done before. And so, most of the operators that I've worked with have actually been in the space for a while. They've either been in banking or they were in commercial real estate in some degree or fashion. And then now they've transitioned into more of the ownership side. And I like to see them own a couple deals. I am typically not investing with somebody for the first time. Mm-hmm. And I accept a lower return because of it. Because what happens is as these guys get better and better track records, they actually ask for more and more of the deal. So they take a bigger acquisition fee, they take more equity, And so the return actually might be about the same. So a lot of times, experienced operators, they actually find better deals typically, but they are taking a larger percentage of the pie. And so your return actually ends up being about the same between a new guy versus an experienced guy. And so that's typically what, and another thing that I like to ask also is sort of who's going to manage the deal. Who's your third party property manager? Because, while like as a limited partner, I'm definitely not there. But then as a general partner, you might be there once a week, maybe, once every other week, once the property gets stabilized. But so it's really going to be like the leasing agent, the regional manager at that company, and how have they performed in that submarket is more important to me in terms of the management of the deal.
Yeah, no, those are some really good points. So, if lots of people watching and listening to the show, maybe they own a couple properties already, they're looking to do their first syndication and step things up. What sort of tips would you give them from an operator from an operator side, just because you have that unique look on it from that passive investing and your lending background?
I mean, a couple things. I would say from the lending side, the group that you're going to form to buy the property is everything. So who is going to be a key principal with you? What are they bringing to the table? So I like to think of it as sort of pieces of a puzzle. And, number one, someone's got to find the deal. Number two, someone's got to have multifamily experience. Number three, someone's got to raise the equity. And number four, someone has to have net worth and liquidity. Mm-hmm. And when you form your sponsorship group, it's important to sort of put the right people together up front, because when you submit offers to a listing broker, they're going to ask you those 4 questions. And if you can't articulate who's going to sign on the loan with you, what type of loan you're going to qualify for, then the listing broker is going to look at you and say, there's no way this guy's closing. So you really have to have those sort of ducks in a row. And then that gives you a lot of comfort with the listing broker, so you actually win the deal. So that's step one. And then from the limited partnership side, I mean, people have done really well with webinars and putting together a nice, 15, 20-page package on exactly why they like the deal, what the background of the sponsors are. I think that is super important. But then once you do the webinar, I mean, you've got to hit the phones and call these people and email them, because I mean, even though I've done, I just did another LP investment earlier this last week, and it still took me like 30 minutes to go through the DocuSign and sending the wire and all this stuff. And then if one thing comes up, these guys are not going to send in the money. And if you're going and raising equity from all these people, I mean, it's going to be, if you're raising money from all these people, you have got to stay on them, because you have hard money at risk. And the only way that you're going to close is if all that money comes in on time, and your reputation's at risk with the listing broker and then also your general partners. And so, I like, if let's say you're going to have, I like to give the example, if you're buying like a $5 million deal, you might get a loan for $4 million. So you got to go raise that $1 million in equity, let's say 50,000 minimums. So you need 20 people. My list, I would have 80 to 100 people, because if somebody, something comes up, something always comes up. And the more people you can have, and even if you have a waiting list, that's fine. I would rather err on the side of caution on the equity side, especially in today's market.
Oh, for sure. And, most guests always suggest you raise, let's say, an additional 30% than what you really need, for sure. So how has getting into real estate changed your life so far?
I mean, going back to 2015, I mean, even though I was in commercial real estate as an underwriter, I think the mentality was, okay, I'm going to have a corporate job. I'm going to invest in a 401k. Roth IRA. And then essentially when GE said, hey, we are selling the entire commercial real estate business to Blackstone, everyone sort of looked around like, is this guy for real? And the people who had passive income, the people who had cash flow coming from outside of their job, they were not scared. They were calm, they were fine. But the people who they relied so heavily on their job, relied so heavily on their 401k and IRA, they were completely panicked. And at that point, even though I'd been following sort of Dave Ramsey's baby steps, your paid for house and your 401k, at the beginning of every month, you did not get paid from those things. Mm-hmm. And that was sort of a wake up for me, was that I needed to start investing in stuff that created passive income. And now through my LP investments, essentially that covers all my expenses and a lot more. And so I don't really have to worry about, where the next paycheck is going to come from. And so it gives you a lot of freedom, and it gives you a lot of, when you take on projects, especially as an entrepreneur or as a self-employed person, I mean, there's a million things that you could be doing. And, whenever I get a, investment opportunity from a general partner, I look at it as, okay, how much, what essentially does this cover in terms of expenses, right? Like if I'm getting $5,000 a year from a new investment, does that cover one more vacation with my family? Or does that cover, your car lease, or whatever does it cover? And I think that way it gives you a lot more flexibility in your life for sure, and gives you a lot more time freedom, because I'm working on an article, and a lot of people, they start either with a lot of time or a lot of money. And what I'm trying to get to is have a lot of time and a lot of money. Yeah. And so I think that as you build your passive income, you get those two things. And what I actually saw at GE, and maybe it was a blessing in disguise, was the people who sort of rose up the ranks at GE. So I was sort of mid-tier person. I mean, I'd been there 10 years, I'd done well, but I wasn't like the 30-year veteran, chief risk officer or anything of GE. What I saw was, as those people, even though they got paid more and more of their time was eaten away by their job, mm-hmm. and more pressure on their position. And, it was almost like it was very difficult to see, because a lot of those people, what's ironic is they spent so much time at their job that they did not dedicate the time to sort of invest in things outside of it. Mm-hmm. And so once somebody cut the sort of, I forgot what someone used, like the retirement, like the legs of a stool, all those legs are being cut out, right? So your 401k, your pension, your Social Security, all those legs are being cut right now. And then if your job gets cut, I mean, you have nothing to invest in any of those. And so I think, that's in a nutshell what it's done for me.
Yeah. And I think it's important to highlight that you've been able to do this in 3 to 4 years. Right. Yeah. Since you started investing, it doesn't take a decade like some people think.
Yeah. I mean, I think the important thing is, you have to make the decision that you aren't going to continue to put, your 20,000 in your 401k and 5,000 in your Roth IRA. You have to save up a large chunk of money. So a majority of these deals, you need 50,000, 75,000, 100,000 in investment. And you can't just, you can't invest like paycheck by paycheck, like a 401k. Yeah. And so I think that's what's important, is you have to be patient, but then when there is a deal, you have to be ready to go. And so my advice is definitely to get educated on your market, on general partners, and start underwriting deals so that when there is a deal that comes up, you're ready to go.
Yeah. Oh, that's good advice. So James, if somebody's looking to get in touch and learn more about what you're doing at Old Capital, where can they find you?
Yeah, the best place is probably my email, just jeng@oldcapitallending.com. My cell is 214-300-5035. And I've got a couple websites. I mean, you could go to txmultifamily.com. That has sort of all the closed deals that I've done in the last 4 or 5 years. And then also we have a podcast, oldcapitalpodcast.com. And we've done about 200 interviews on there. And then we also have a conference. So oldcapitalconference.com is where you can find our conference information as well.
That's great. Well, James, just want to say thanks so much for taking the time and sharing your success with us today.
Great. Thanks a lot, Seth.
Perfect. And to you, our viewers, I wish you well in your journey from purchase to profits. See you next time.